This will be a bit of a trade review for all the trades I've seen this week, or whichever ones I can get around to. It is currently Tuesday, the 9th of December, just after the close, and I'll be focusing mainly on gold. There was one trade on NASDAQ yesterday that I do want to mention, but in general, I want to focus on gold. Do a brief top down just to give an idea of where we are at and my bias going into the week. So clearly the high time frame is looking fairly bullish, and I do expect us to take out these highs eventually. However, I was a bit thrown off that we didn't come below this previous week low over here. The way that we've been creating these lows on the way up makes me think that we could easily have another flush down through the lows. But because we are bullish high time frame and the daily trend currently is also going higher, I'm more focused on bullishness. But that being said, we are in this area where we could see a bit of a consolidation. It's at a premium of this range on the created by this weekly candle. So it's in the area where it can easily go either way. And I want to be trading with that in mind, not expecting us to continuously expand in one direction. But then just having in the back of my mind that it is high time frame bullish. You can see that we had Friday, ran out all this buy side, took out, hit that old previous week high, took out this nice swing high, rejected lower, and we then pushed down into the range. When Friday closes with a really long wick like this, I see this as them creating sentiment going into the weekend. Traders will see this and think, wow, that's such a bearish rejection, great place to get short. And a lot of the time that will result in it just getting absolutely overlapped. So there is a good chance, I reckon, with FOMC tomorrow, I believe, that we do rip up through this high. But initially in the week, I was bearish, looking for that previous week low to get taken out, previous day low, sorry. And that's simply because we had this rally the previous week. We had pulled back, created this really long wick with relatively equal lows, and then just consolidated into the Friday close without really taking out much in the way of sell side. So with this being a new week, it did make sense for us to first take the previous day low, especially since we are bullish high time frame. If we're going to see a bullish move, it makes more sense to take sell side first and then revert to targeting buy side. And that's kind of what we're seeing right here. We did hit the previous day high already today, but to me, it looks like it should keep on ripping. Now I'll go straight to the 1 hour chart. You can see the 4 hour on the right. That's Friday's close, selling off, creating this really long wick. And I'll get to this later. This is very significant as to why it gave the narrative for yesterday anyway. A lot of smooth lows below, so it made a lot of sense for us to continue pushing down into those lows. We then had a reversal down here. After hitting the previous day low, you'll notice that we also hit the liquidity midpoint, which is a concept of the midpoint between two significant pools of liquidity. If we were to be bearish, we would have closed below the midpoint, but the fact that we respected it was an indication of a key point to reverse from. There was a very beautiful trade in here that I want to go over today that sent us up into the range. And then you can see that we've been leaving these long wicks with some smooth lows, so indicating a likelihood of coming back down here. And on top of that, we did already hit this buy side. And however, I am actually thinking we could easily head back up here because just the way that this long wick worked into this buy side, started moving lower, but then failed to continuously displace. That's an indication of this being a potential false high. And what I'm sort of anticipating is a potential run back above this high before potentially heading back down into the range, and maybe we could accumulate below this low again. But Yeah, but essentially looking for us to potentially reach back up to this high, and that's what I based the longs in the PM session on gold on today. Been talking through, yeah. Sorry, my brain's still getting going. So rather than just talking through this top down, I'll just jump straight to the chart and quickly show exactly what I was looking at. Bring the 5-minute up on the left. This is the PM session. That's that 1 hour high that hits the buy side. You can see that we have equal opening prices here, 11 a.m. and 12. Both of those indicate potential original consolidation. That is also forming at this new week opening gap, which is also another confluence for a original consolidation. So both those things combined indicators that price was likely to want to return back up here after expanding lower. Now, usually I'd be looking for us to take out the really obvious impulsive low, especially on the 5-minute charts. However, we didn't quite reach that. And initially in this area, I was leaning a bit on the bearish side, but I recognized that that was not the right play, and I was actually able to catch a long instead. What allowed me to pivot to the long side is, for one, if we were bearish, it would have needed to have rejected from some buy side. We had not done so. We failed to hit this buy side, had this aggressive move lower, and we were just consolidating down here when I came to the chart. Usually, if we were bearish, you'd expect, okay, well, we spent heaps of time up at this premium, aggressive drop lower, price should not come back up through this range. However, because it was such an aggressive drop that hit a whole bunch of sell side, leaving these smooth highs intact, and then it failed to just continue pushing lower. To me, it was just trapping people short and looking to rip back up. So I didn't do anything in this range, but once it did push up, that narrative was clearly in play. And I recognized that I had my delirium framework present as well, which is essentially when we have relatively equal highs, these two here, with a impulse high above, and it makes this a very high probability target. We also have the midpoint of the dealing range from the low up to the high. You can see that we came into the area right here. So working our way up and touching that original consolidation opening prices before pulling back. So where I caught the long from was actually just in this area here. And the reason being is because I started recognizing the narrative I talked about before, where we had some really obvious highs through this range. We had that really obvious 1 hourly high that did hit buy side, but it also looks like it was put there as kind of like a decoy for anyone who is looking to go short from above those highs to put their stops up there. Price should hopefully run up there and then sell off. So I was still bullish essentially. We had hit EQ, but I was still bullish. And you'll see this big purple box. That's just a new day opening gap from the previous day high that we just rated. So this day opened, we got the previous day high, we rated that previous day high, broke back below. What I use those boxes for is after we've accumulated, let's say I'm bearish, I want to see us accumulate above, so accumulate buy stops and a net short position, and then once we do break back below that, I'd expect it to act as resistance. So let's say we actually sell off from here, I'd expect something like that. After seeing we had hit EQ, I was still very interested in us hitting this buy side up here. So I wanted to identify where a good place to get in would be. Now, 2 p.m. opens up, it engineers this liquidity pool and then rallies. And this was really key because this indicators that we were potentially looking to accumulate below that low. It also occurred at the NDOG VIP, as I mentioned, and we had the narrative of there being traps traders down in these lows. That's essentially because we had this consolidation at relative equal highs, a aggressive move lower, enticing shorts, time spent at these lows, trapping people on the short side, and then an aggressive rally back up. That sequence of events indicates that there's a likelihood people will get selling down here from seeing their resistance at the equal highs. And so I anticipate that if we're bullish, price should not return down to this area and let any trap traders out of their position. Instead, I want to see price rally up to the buy side. So after engineering that sell side pull at 2 p.m., we drop down into the range and we have 1, 2, 3 drives into the lows and then rip up from there. And this happens right at the final 15-minute candle as well. We actually engineered a really big up closing candle. If you zoom into the 5 minutes, this is a 15-minute candle low, but this is a 5-minute big up closing candle, instantly reverses and then takes out the low before ripping. And that ended up being the trade to be in. I took a partial as we hit this flat candles, this flat candle. Added again once we took out this swing low on this candle here. Rode it up into the highs, took a partial at this swing point. But I was actually aiming for this swing high up here as like a what I thought would be a pretty easy target, but it ends up just reversing straight back down. Now, I did actually trail my stop up to this lower gap. I recognize that this was a very clear previous area of accumulation and a order block, and that we could easily drop into it. But with how price was moving, I wanted to see just continuation push. So I put my stop there. I walked away from the computer. We had 3 drives into the highs and then broke down into my stop loss. The lesson from this particular area is that in a delta condition, which is when the high time frame draw or intermediate trend is against the direction I'm looking at or aren't in alignment, then I could probably use a 3 drive pattern as a way to give me a specific way and time that I should be tightening my risk. So let's say I'm in this trade, I'm happy with my stop being there. I know it's a delta trade, so I need to be taking that base hit. But then we get this 3 drive pattern. As soon as we get a 3 drive pattern, you don't want to see it reverse. So maybe when we do get the third break of the high, I should make it a mandatory rule to move my stop up to a reasonable area or start using a 2-minute trailing stop. So that broke back down. I do believe we could still hit higher, and that's partly because this is a hourly candle high. In fact, we can draw that out onto this hourly chart. You can see that hourly high, we fell just short of it. And that is very likely that we do hit that high. The fact that we fell short of it and dropped back into the range indicates this is potentially reaccumulation. Now, reaccumulation is just a failure to reach a specific target and then a retracement back to a previous area of accumulation to reaccumulate. And that appears to be exactly what's going on here. I'm very tempted to get in right here, but as you can see, it's 4:30 p.m. So I don't know if it's the smartest idea buying right here. I could very easily just close down here and then rip at the open. But at the same time, we do have smooth lows below us, as well as this impulse low. And yeah, I caught a nice win in this area. I then took a stop out. I tried one more trade here. I actually bought right up in this area with a very tight stop, and it just took me out. But yeah, this does look like it could come up back up for another run. And what's cool about the 3 drive pattern is that sure, it's a reversal pattern, but if it does fail, so if we do now run higher despite this 3 drive pattern, that's a very strong signature of a continuation, and I'd be very confident in us sitting this high. Another concept I'd like to go over briefly is the strong closure concept. So a strong close, I'll find an example real quick. I'm sure we had some up here somewhere. Well, I'll just explain it. doesn't matter too much about the example. A strong close is when we have a range. So let's say this is our dealing range, however you define a range. And then we've got candles inside that range. Let's say we're bullish and price reverse and it's heading back into this dealing range. And this is the midpoint of the dealing range. That's what that line represents. A strong closure is when you get a candle that closes through the midpoint of the range. So make that a blue candle. And then you get a second candle that closes also above that midpoint of the range without retesting it. So we don't have any wick dropping down like that. If there is a wick, it just doesn't quite reach that midpoint. And I'll actually draw that out like so. And once you get that signature, that is a strong closure. And when you pair that with a framework, or the correct framework, then that indicates that it's likely to head to the extreme of the range. How I use this is I can then use it to define risk. So let's say we then had a price had done something like this prior. So it'd been something like that. So I'm just drawing a few lines. But essentially I'd identify the starting point of that displacement that created the strong closure. And in this particular instance, it would be down here. And then that becomes the invalidation. Once we get a strong closure through that, I call it the SR mid, then yeah, price should not return down to the discount of that price move, which is not the discount, the starting point of that displacement that created the strong closure, which in this instance would be right there. We kind of have that happening here. However, it's not quite with this right framework and context that I usually use. Normally, I use this with my squeeze reversal framework, which is when we fail to take out a previous hourly candle high or whatever time frame, and then reverse. Then I expect us to hit the opposing end of that candle. And that did not quite happen here. You see that 1 p.m. did actually take out the 12 o'clock low. So it doesn't technically count, but we do still have a bit of a dealing range if we draw this up from there to there. We've got a bit of a dealing range and we do have a midpoint of that range. So I'm only saying that I don't really know if this is quite it because it's not specific to the model that I created it for, but it might still work and it's something I am observing. But you can see that we did get that play out here where we had a strong closure. We had a really strong close above this line. The next candle also closed above that line without retesting it. One of the characteristics of a strong closure is that a lot of the time it will retrace very deeply towards that liquidity start. And you see that here, we have the starting point of that displacement candle that closed through the midpoint. And now we've retraced really deep into the range, which is what I would expect if this was a squeeze reversal framework, which it's not, but it's still a signature that might appear outside of it, which is what I'm observing right now. What I like about the fact that we're retracing into this area is that this low staying intact is supported by that narrative of the strong closure, and also with the narrative of this being a previous era of accumulation, meaning that we could get reaccumulation in this area before hitting higher. I am also noticing how we've got these equal opening prices. That's also indicating a consolidation, but not too clear how to use that just yet. That's quite interesting though. I'll go down to this area now and just talk through this trade. So clearly we can see what had happened overnight. We had, this is Monday, New York session sold off after consolidating, and we're looking for second stage of the market maker model. And that's because we have the reversal, we have a intermediate term high, short term high, first stage, and now we're looking for second stage. And for second stage, you're looking for to remain heavy and a institutional order flow entry drill. And that's what we have here. We have this big range, but we only just get above that midpoint, fail to really get much above the highs, and then sell off aggressively. So those are all signatures of the second stage of the model. What happens after second stage, a lot of the time, is a reversal. So that was kind of the framework initially. We then have a previous day low down here and a previous weekly low. I'll bring up a slightly different time frame so we can see that. But previous day and previous weekly low. I already mentioned the midpoint between those two areas is the liquidity mid. We reversed from the liquidity mid, so that's the first clue that, okay, this could actually be something. So we reversed from liquidity mid. It was after we just had second stage of the model, which is when you are likely to get a smart money reversal as well. And then on top of that, we also had been selling off all day. If you look at this area in here, ever since 2300, we didn't really take any buy side at all. We just sold off the entire time. So the fact we were reversing back up, it kind of gave the narrative that there would be people wanting to trail their stops. So that's the trailed stops narrative. And yeah, a likelihood that we would run against buy side. The most obvious buy side to me stands out as this high, which is essentially delirium as well, a impulse high with smooth highs below it. It's also at the midnight price. But after this aggressive reversal, imagine if you're short through this range. You want somewhere to trail your stop. People typically trail their stops to swing highs and swing lows. So when we rally high, anyone who's short, they're going to get nervous. We then have this lovely sell-off into the range. Anyone who's short have a big sigh of relief. They move their stop loss to this high. When we sold off into this range, we had a very similar situation happening here as we had up here at 2 p.m. today, where we had an hourly candle open, rally, spend time at a premium, and then drop into the sell side. You can see that same thing here happening here. We have a 2 p.m. candle opening, 2 a.m. a rally, and then it drops down below the sell side pool. We also hit this impulse low, get a nice reaction out of that, and then just start consolidating. Through this range, initially I looked at it, I was like, oh yeah, like everyone's going to think it's bearish. It could be bearish. But then I started seeing the narrative and being really objective. And I was really happy with this because my whole decision to go long here was based on objective observations. The first ones I've already mentioned, of this being second stage and the liquidity mid. The next one was the fact that this hourly open that becomes your bullish order block. You measure the midpoint from the opening price to the low. That's mean threshold. We were respecting that very nicely. We weren't even closing past the upper quadrant of the range. So I could tell that, okay, 1 p.m. did respect liquidity mid from below the previous day low. We are respecting that 1 a.m. order block. We are taking out sell side below the 2 a.m. open after having already enticed longs. We have the narrative of trailed stops, and this is likely going to be a long. If you zoom in a bit, you can see this consolidation below this swing high. If anyone's getting short through here, where are they putting the stops? Well, obviously above these highs, but then also most likely all the way up here. The fact that we had this very aggressive move up into the range was the first indication that, okay, this could actually continue pushing towards this high, especially with the narrative being that people were shorting, chasing this move down, and through this range, they're getting short. That was supported by the fact that we failed to drop into this fair value gap. So that's indicating that, yep, we have indeed trapped traders short below this low or below this area, and we don't want to let them out of their position before we run up to the buy side. And we ended up having that beautiful run high, and yeah, I stopped trading at this point. As you can see, that had a beautiful rip at 4 a.m. Really nice. I haven't actually looked at that yet. But yeah, just accelerating into those highs. And what I love about this as well is how it didn't just hit these highs. it rips straight above. And this is once again my delirium framework. We have relatively equal highs with a really obvious impulse high above it. And it doesn't just hit those highs, it hits this one. It's kind of like a decoy kind of concept where you have a really obvious area where everyone's going to think, okay, there's a great place to, get short from, and I'm kind of put my stop loss there, or just to be extra safe, it's definitely going to reverse from these equal highs. So I'm going to put my stop loss at this next swing high, and that results in these beautiful rips up to that high. Those are some of the best ways to get the trades that go further than you would expect. Is identifying areas where traders will be placing, looking for a place to hold, and not and the market just punishing them essentially, because we've all been in trades where you buy. Let's see if I can draw up an example. You think, okay, I'm going to buy right here below this low, and I'm going to put my stop loss. This is what you expect to happen, and I reckon if I buy down here and I can put my stop loss below this next low, because this gives it heaps of room. It's probably not going to come down there. Typically, price will, if you're wrong, price won't just come down here and then come up and then come down like that. It could, but more likely it's going to just come down in a very painful, direct manner like that. And you're capitalizing on that aggressive movement towards that deeper area of stops. So not just coming here, they're coming a lot further down. So traders might also be buying here, thinking, okay, cool, I'm going to put my stop loss here. That's great. I expect price is going to come down, tap it, and rip high. But what happens? Price goes straight to where their stop would be. But a lot of traders might not even have a stop, or they might go, oh, maybe it just needs a bit more room. You know what? It definitely won't come down here. And then price will just move steadily in one direction. So you're identifying those kind of areas. And this is a great example of it, where traders might be thinking, okay, cool. If I go short at the equal highs, I put my stop loss just a little bit above them. Or if I'm not that dumb, I'm just going to put myself in a really safe place at this really strong high that's rejected from there, expecting that even if they're wrong, price is probably going to come up here and then give them a bit of profit and they can get back to break even or something. But that wasn't the case. So that's kind of what's happening in this area. Let me see. There is so many things, like the squeeze reversal. That's probably the one I've been using the most this week. There was a beautiful squeeze reversal short on Friday. I caught this short from here, added, and my minimum target was supposed to be this low. However, as you can see, I was leaving all these smooth highs on the way down. There was no clean place to trail my stop loss based on my framework rules, which I've since adjusted. But yeah, I ended up taking off the trade. I actually got stopped out right there because we just had all these smooth highs. We had a really strong looking reversal from down here from a really key point of interest. And then it started showing bullish price action. So I figured, okay, well, I can't leave my stop loss all the way up here. I just closed it out. But usually this would have been the minimum take profit. You can see it hit that beautifully. I'm not going to explain squeeze reversals right now, but I've been putting a lot of work into developing a trade plan for it recently, and it is beginning to pay. It's beginning to pay. We also have one here, and I caught this one as well. Initially, I was getting long in this area. It stopped me out, came straight back up. I got back in and then rode it up into these highs. And then we have this one. So the reason why this one I was confident in, despite us leaving these perfect equal highs, and the same with this one here, is because it's a consolidation and it's occurring at the new week opening gap. Consolidations tend to happen with a few key signatures. The first one being Obviously, relative equal highs and relative equal lows. That's very typical of a consolidation, original consolidation. Consolidatory type price action. That's another very obvious one. The next one, which you can see very clearly on this chart, is when the hourly opening prices are equal, when they're at a level kind of area. That indicates also that's the original consolidation. The next one is when we are at a institutional price level. With this particular instance, we are slightly below it, but you do see we have the 20s right here. So 20, 50, 80, and big figure 100 levels, all of those kind of institutional levels. And that's also an area where price likes to go to engineer liquidity. And that's essentially what a original consolidation is liquidity being engineered for the purpose of coming back to at a later date, which is why relative equal highs are no worries at all. Institutional levels are no worries, and also why having a new week opening gap or a new day opening gap at that area is a very strong confluence. Daily and weekly opening gaps, the whole point of them is, well, the point of why price uses them is because the market wants to invite buying and selling transactions within these price ranges. So between that price range, there was that gap at the weekly open, and so there was a void of any transactions in that area. In order to facilitate trades at those price levels, there needs to be liquidity. So price will come below it, engineer that liquidity. So there's going to be a whole bunch of buy and sell orders in this range. And then when it returns to it at a later date, it facilitates those trades within that price range. So that's another key signature of it. And the final signature, I'm not sure if we do have one or not. We probably do. But the final signature of a manipulation is a manipulation closure, which is essentially when we have a closure above the midpoint of a wick or disrespecting the midpoint of an order block. There'll be plenty here, but I can't be bothered finding them right now. But if you imagine if, let's say, for example, there was a long wick here, and then the candle to the right of it closed well above the midpoint, which would usually indicate bullishness, and then it instantly reversed and went the other way. That is essentially the same as leaving relative equal highs, but that would indicate a manipulation closure, making it strong confluence. But I recognized those signatures. I saw this area in here, caught a beautiful short down into this range. It was actually using this manipulation candle low, not manipulation candle, sorry. My brain's really slow today, but yeah. We have a really obvious impulse low below. We then rally, we create the most discount internal range low that is also an impulsive low. Rallies into the high, spends a bunch of time up here, breaks that low. Now this is already a intermediate term low. If price is going to reverse and head back up, one, it won't take out this low, and two, this is the most discount low it can reverse from. So we'd want to see a strong rejection from this low and it would rip higher. That happens, that's great. But then it fails, comes straight back down. That moment right there on that candle closure, that is the impulse rejection failure entry signal. And the idea is that you can just get short, put your stop loss at that failure swing high, and it sells off. That's exactly what happens. Last of all, I'm just going to jump over to NASDAQ. I'm only getting through like a fifth of the things I want to talk about, but I've got a lot of other stuff to do today. So I want to try and get this done really fast. If that wants to load, I'll clean up some drawings in the meantime. There we go. So this is NASDAQ at the moment. It's in a bit of a funny looking area. But I want to go over the trades from down in this area, Monday PM session. Not sure if that's loading at all. Maybe my internet's really bad. Unsure. Yeah, today, not a fan of the price action on Nasdaq today. Just super high resistance all throughout the AM session, leaving these smooth lows as well, but super high resistance. And then just consolidating all PM session. Not what you want to trade. Uh, but yeah, this is the PM session yesterday. I already mentioned before that PM session is actually becoming one of my best times to trade. And the reason is simply, this is all it is, it's because I wake up at the start of the PM session. So I'm the freshest at the PM session, whereas before I was always getting up for the London close slash, yeah, for the pre-market essentially, for like 6 a.m. to trades the New York session at 9:30. And I was terrible at the PM session. Like, it was my absolute worst session. Asia was pretty bad as well. But now PM session in Asia, I always find the most epic trades. But this is a good example of that. We had the PM session, we'd sold off all day. We had this low engineered, a nice rally, trapping longs at the highs, and then sold off below this sell side. What you'll notice here is that we have the same original consolidation concept with these equal hourly opening prices. The point of interest we're at is also a key point of interest where we have this, my charts just aren't loading, sorry, but this low, and this is significant because we have this rally the previous day, a key sell side pull engineered, and then a enticement higher. So trailed stops are all going to pull at that low. We then accumulate below it, run higher, and then consolidate. And hold up. No, am I confusing myself or what? I think that's right. But yeah, we accumulate below that low with 1, 2, 3 drives, so a previous area of accumulation. We then engineer sell side pull above that previous area of accumulation. We then take it out right here. So very strong point of interest. 3 drives accumulating below the sell side and the previous old low. A impulse low engineered. We then raise that impulse low into that area. We're sold off all day. We've got trailed stops above this high. A lot of stuff going as to why this would be a great place to buy. But we're leaving kind of smooth lows. Like you can see, high, low, high, low, high, low. It looks a bit sketchy. What made me trust this and trust that we were going to rip up to this high were multiple things, but the main one being that this was a original consolidation. So it's like, well, that indicates that we're likely to leave smooth lows. I should not be worried about it at all. Also, the fact that we have this buy side up here, you can see this buy side pull. We did not hit it at this point. And if you measure from this 1 minute swing high up to the next 1 minute swing high, do we or do we not close above the midpoint? We do. That indicates that we're likely to head up to this high. If we're going to hit that high, very, very likely we get up to here. We have these perfectly smooth highs up at the premium end of this range as well. And we were in the PM session after consolidating for quite a while at the lows. So I was anticipating that the 1550 macro, so 3:50 p.m., would be likely to rip higher. And you can see that happened here. We had this sell side accumulated. We then engineered all this internal range. We spiked below it and then traded higher, making this a beautiful place to buy. Trusting that this intermediate term low would stay intact, and that just rips really nicely into the close. And that's essentially that trade. But kind of a literally not getting to half the stuff that I want to get to today. But that's because I do have a lot of stuff to do. Just thought I'd go over a few things that stood out to me because, yeah, there's been heaps of insane trades this week, especially the squeeze reversals. They're happening all the time, which is perfect because that's what I'm working at the moment. But I just don't have quite the time to do the in-depth reviews that I want to do, including markups. So I just need to select a few key moments to mark up and yeah, just not worry about it. But yeah, hopefully you found something on there useful, some useful information to go and test. I just recommend if you're going to test one thing, just go and identify wherever you see in a like multiple hourly opening prices at the same area, such as right here. See this as being a consolidation and then see how price references that going forward. That's what I would recommend. So yeah, best of luck for the rest of the week.